It's one of those global days where mostly things are down. Big jump in CBOE VIX last night, and of course a 3%, 3.5% cut, led by the Nvidia and the semiconductor space, which sold off aggressively. A bunch of reasons, but I think the takeaway is that perhaps out there in the US, it could be a bit of a corrective kind of a phase. It's possible, and not just like a one-day wonder. Yesterday, of course, was sharp. There was also this element that if you think about it, I mean, the previous day, Monday was a holiday, but on Friday, there was a late 1 hour US market close surge of about 1% or so. So when you look at this 3.5% cut, there was that give back out of the holiday. And of course, then some more because of Nvidia and other reasons as well. So first rates coming up on the Nifty. What do we have? Where are we starting? We're starting at 25,100 straight up with a 150, 170 odd point cut. The Sensex is down about 550 odd points. 500 now. 82,056 is where the Sensex is at. Bank Nifty starting about 230 points lower. That's about 0.46, 0.5%. 51,450 is where the Nifty Bank is trading at. You've got what else? Advanced decline naturally, sharply down, about 4:1, more than 4:1 in favor of what's down. And if you needed a clear kind of sense of, what's happening, just look at the heat map. 4 Nifty stocks are higher, and the rest of the 46 names are actually in the red, at least as far as the starting prices are concerned. So we're in line with what the GIFT Nifty indicative opening was, down about 170. Surabhi.
Okay, I'm just seeing, where the green is. There's not much, barring companies that benefit with the huge fall in oil prices. So your oil marketing firms, BPCL, HPCL and IOC, that's where there's a little bit of a hint of green. And Asian Paints, like Nigel pointed out, that, paint stocks, technically, theoretically, they're beneficiaries when oil prices go down, but then we have different competitive intensity and issues at play here in the Indian market. But for what it's worth, Asian Paints is the second best performing stock on the Nifty. However, the rest of it is all down and out. So ONGC, Hindalco, a lot of profit taking on IT, Wipro, LTI, Mindtree, Infosys, TCS, all of the major IT names, Tech Mahindra with a huge sell-off overnight as well. So IT is seeing a lot of profit taking. Other large stocks like L&T, down about 1%, Let's look at Reliance. Reliance is down about 0.5% at this point in time. HDFC Bank is trying to fight back a little bit, but not too many other banks. The Bank Nifty is also down 0.5%. If you look at the other names like an ICICI, it's still down about 0.6%. State Bank of India is still down about 1% or so. So IT and banks not quite working. That's sort of the weak part of the market. We're still dealing with the same blow, 180 points as of now. Still letting the market do its thing, and the gap kind of settle very early on into the morning. Nigel.
Well, that's right. Crude prices are weak. So Oil India and ONGC, both of them are lower in trade, getting smacked as we speak, down 3% each. Zomato's had a big run. That stock has pulled back. So two sectors actually have come in for profit taking. You have the commodity-related names like ONGC, Oil India. You have the metal index itself that's under pressure because of the global jitters. That's point number one. Point number two is you have the IT index as well. That's under pressure because of the global jitters itself and what happened with Nvidia overnight, where it lost close on $290 to $300 billion. But there are a few pockets of strength. Pull up OMCs. They are doing well. BPCL, IOC, top volume gainers in today's trading session. GMR Power has already had a big run. Take a look at that stock. In a market that's down 180 points, you have GMR that's moving up. That one's up close to 5% as we speak, and one of the top volume movers in today's trade. To highlight a few more names, Sudarshan had a short call on Birlasoft. That stock's under pressure. It's down 2.5%. Mid-cap IT has pulled back considerably. Birlasoft, Emphasis, Coforge, all of them under pressure in trade today. Strides is higher from the F&O basket, up close to around 1.5%. So it's a weak start on expected lines. The Nifty Bank, the reference point that we gave you earlier today, was 51,250. For the time being, that's held out as of now.
Defense stocks, they're the ones that are seeing buying.
On the offense.
Defense on the offense. That's a nice line. But yes, we are seeing between 0.5% to 1.5% on the shipbuilders, on stocks like Masgao Dock as well. The timing Garden reaches up about 1%, BEML, Cochin Shipyard, some green over here. By the way, check out JK Tyre. I was checking tire stocks. Typically, tires and paints are the beneficiaries with big fall in oil prices, if the fall is going to sustain, that is. JK is better off than the rest. Otherwise, not seeing so much of a move on CAT and MRF. They are fairly flat at this point in time.
All right. Well, so it's that's that kind of a market where mostly it's everything down because of what we saw overnight as far as the global picture is concerned. Well, let's welcome in some technical perspective now. Atul Suri is the market master today. He's CEO Marathon Trends PMS. He's joining us now on the program. Atul, good morning. Great to have you with us here on CNBC TV18. Prashant here. Where are we now, Atul, in terms of the market picture? This seasonality going into the election has been talked about widely. It's well advertised. So are we entering a bit of a sideways, even corrective phase for global markets, US especially? And if the answer to that is yes, what does that mean for India here? Because so far, not very much has mattered. I mean, we've continued our up move.
Yeah, I know that we are, speaking on a day when markets are down globally. So obviously the mood and questioning is different. But it's nice to take a step back and, if you look at markets in a little bigger time frame with a broader brushstroke, essentially there are four global asset classes, and I'll cover each one of them to understand where we are. The first is global equities. Again, barring yesterday's move, global markets are at lifetime highs. It's not just India, but even if you find the US is nudging there, a lot of global markets are at lifetime highs. So a 1% move or 2% really doesn't say much. So the first thing is that the quadrant that we like to focus on, which is global equities, they are globally pushing towards lifetime highs. Number two is commodities. If you look at commodities, it was a very big concern. Inflation was a very big concern in 2021, 22, 23. And if you find that even commodity prices are much softer than where they were 2 years ago. So that whole issue of inflation, which was, dominating us, also comes under the lid. The third asset class, which I think is very important and relevant, is US bond yields. And you'll find that there is been a decline in US bond yields. And going ahead, there is a feeling that the Fed is going to cut. And fourth is currencies. If you look at the US dollar, you look at the DXY, which is around 100. So what really happens is, Prashant, dare I say, on a day when the markets are down, that actually most of the places that the right thing is at the right place. So all the quadrants are actually behaving out pretty good on a larger or a macro scale. Now, the issue that comes up is yes, there can be volatility in the short run. September is seasonally known to be a volatile month. And for that, I think it is going to be a reality. We will have to live with it. But as far as the bigger picture goes, the four asset classes that I mentioned, and there is a lot of correlation or overlap that happens. As I said, I'm not speaking for one day or 1 week or 1 month. But if you look at the bigger macros, dare I say the world has enjoyed a Goldilocks. In that
And
sense of the term, a Goldilocks is when most things are where they ought to be. Yes, it will never be perfect alignment at all points in times. Things will swing, just as inflation dominated and recession fears are there. But overall, I don't think there are any very, very big issues. The point where I would be concerned as far as markets go, whether it's globally or India, would be that if we break the August lows. Remember, August was a very volatile month when you had a yen carry trade issue. And again, there was some data and there's a fear of a recession. So US had corrected almost 8.5, 9%. Japan was much sharper. India corrected about 4 to 5%. So for me, the reference point for this volatility or for the month is all is well till we don't break August lows. Yes, if we break August lows, then we need to get back to the drawing board and reconsider things. So yes, volatility is there. September has been historically volatile, but the bigger picture, the bigger asset class plays seem okay to me.
And that's very well explained, all the four quadrants as you put it, Atul. But would you want to put odds to it? What's the chance, what's the likelihood of that happening, the getting back to the August lows at some point over the next couple of months?
I, for one, would give it a higher probability that we'll break out on the upside. Yes,
Okay.
volatility will remain and it will give us panic. But I do think that global markets have a good 5 to 7% or maybe 8 to 10% higher from where we are. And that goes for India also. So I do think that breakouts were made earlier. Those targets have yet to be achieved. The journey can never be linear. It can never be a straight line. It has to be volatile. And what we are seeing is part of that volatility. So I think it's something you will have to live with. What I'm noticing, Prashant, and which is more relevant, is that in the last 2 months or so, more so I would say post-elections, the behavior of sectorial churn is very evident to me in India. And I think for me, I'm not taking cash calls, but for me as an investor, as a portfolio manager, what is changing is that the sector or themes that were leading the market, I feel are changing. And that may be a time to recalibrate and move some things around.
I was just going to come to that. Atul, this is really interesting. I keep going back to your line, right? The trend is your friend until it bends, and it's not bending from what you're saying. We're not at the point of bend, at least as of now. You're saying probably higher chances of a breakout on the upside than on the downside. So now with the overall market context quite clear to us, let's talk about the changes that one may need to make to their portfolio in here. I mean, it's been all about capex stocks, manufacturing, defense, railways, all of that. Do you see anything changing there? And then we've had a lot of false starts on things like large banks or even FMCG. Every day every time there's a scare in the market, we see some of these FMCG names do well, and then they fall by the wayside again. Any changes that you forecast here?
Yeah, so that's exactly the point I was talking to earlier. That in the last 2 to 3 months, what I find is that certain sectors or themes that dominated the markets for 2 years, 3 years have started underperforming, and some sectors have really taken the bull by the horn. So let me name them. I feel that the sectors there are three sectors that really stand out to me, which have done very well. One is pharma. I think pharma is one sector which has been pretty much ignored by the market. It's been laid by the wayside, but there are a lot of pharma stocks, and it's a very large sector in India. So I find that a lot of pharma stocks seem to be making new highs. And that's very, very positive because they are bucking the overall trend. The second sector, which again is a very important sector, probably the second largest sector in India, is IT. I also feel that I know that there is volatility today because of Nasdaq, etc. But on a larger theme, I see a lot of IT stocks breaking out, and I feel that that sector or that theme also is playing out very well. Again, something that has underperformed for the last 2 to 3 years. The third sector, which I find again interesting, is the whole consumption space. And this is where your FMCG and consumption stocks come in. So to some extent, I get a feeling that the market is little moving towards defensive, things like pharma and FMCG. And yes, to offset that, you realize that some of the industrials have started cooling off a wee bit. Mind you, they've had a 3 year bull market. So in the last 2 to 3 months, we are seeing industrials little bit cool off. So I think that's where the point that comes for me as a fund manager is that do we need to change because the trend we feel in leadership is changing, and we are doing that because we find some of these places like pharma and IT giving us very, very good opportunities and breakouts. And this is evident also if you look at some sectors which are divided. The most important sector in India is banking, right? You'll find that PSU banks dominated the whole banking space. They were the sector, that are the stocks that did well for the last, again, 2 to 3 years. But you'll find that financials are actually doing very well. So a lot of money is moving into your broking stocks, AMC stocks, insurance stocks, etc. So I find that there's a shift that is happening even within sectors because we term banks and financials in one breath. But I feel banks are behaving separately and financials are behaving separately. So these are the kind of shifts that I'm seeing in the market in the last few months.
All right. Hi, Atul. Good morning and always good to see you in. Atul, just to clear the point on the headline index, that's a Nifty. If we hold those August lows, then we could possibly trend up 8 to 10% even from these levels?
I think so, because if memory serves me right, it was around 23,900,
Yes.
which should be around 5% or so lower from here. So I feel you will have to give the market some space to play. And as Prashant pointed out earlier, that seasonally September has been a volatile month, and one has to be prepared for that. But as I said, the key thing, Nigel, is in my view not going to be the market per se. It's going to be more the sectors and themes, because in these times of churns, what you will find is that new leadership emerges. And I feel that after 2 to 3 years of a secular trend, especially like the PSUs for that matter, you'll find that there could be a shift that is happening here.
Okay, all right. Got that out of the way. Personally, September is a good month for me, but I was just saying seasonally for the markets, it's not great. So we'll keep that aside. Let's focus on a couple of other trends then. Crude oil prices being lower, a good thing from an India market perspective. And we have a couple of sectors, themes that are doing well. Paints is doing well today because of the lower crude prices, and that's been a rank underperforming sector. So first, your view on crude oil prices. We're holding at around $73 per barrel, which none of the Nifty bulls are complaining. But where's it headed?
Yeah, so I think for Brent to actually come to around 70 would be a good place. 70 has historically been a very big support for Brent crude, and I think that Brent is heading there. Well, if it breaks that, then in fact I find sometimes that it may be in kind of a bit of a worry also, because if commodities crack big time, yes, it may feel good in the short run. Some stocks may benefit, but it may actually put a question mark on the overall health of the economy, because you need commodities for growth. You need commodities in a growing economy. If commodities crack, that clearly would imply that, the world is heading to a different scene where recession or underperformance in a lot of the other stocks would play out. So for me, commodities in a band, currency in a band is always a good idea. If it does too much, it always creates a problem. So as I said, I'm very happy that crude where it is, or even if it goes up to 70. So commodities as a whole, as I said, is something I watch very closely because it's very closely linked to inflation. And remember, the last 3 years have been dominated by inflation. Yes, we are coming out of the fear, but it shouldn't be that they even swing the other side. Because if they swing too far on the other side, it would imply that the demand for commodities is out, which would imply that there is a problem where recession could be coming. So range-bound commodities, range-bound currencies is what I love.
Got it. Atul, do you think, globally as well, right? I mean, in the US, and you watch that market also pretty closely, we will, as you're saying, new leadership will emerge. We're at that point where that market also will do that. I'm asking because the outsized importance, right? 5 stocks, these large tech stocks, is about 30% of the S&P market cap.
In fact,
And
Prashant,
the big,
it's
the
sorry,
big, the big,
sorry.
sorry,
In fact,
the big one.
it's all reduced to one stock, Nvidia.
Nvidia. And exactly. So I was coming to that. Nvidia, as of yesterday's 9.5 to yesterday's 9.5% cut, is if 20% is the cutoff for a bear market, it's down 23% from its June highs. So are we at that
Prashant,
point in the US as well?
Nvidia went
Yeah.
into a bear market last month also, and again it
And
made
then
a new high. So
but
yeah, these 20% rules in stocks like Nvidia, 20% is good for an index level, but in stocks like Nvidia and some of these tech stocks, it's a matter of 1 week. So
yeah.
Nvidia is different. I mean, as I said, that I have never seen. We were talking about FANG stocks and Super 7, but I have never seen one stock actually dominate the market as much as, or the importance of one stock, which is Nvidia, because it affects the whole sector, the whole semiconductor space. Yeah, but then these are realities, you have to live with it, Prashant. At all points in
Sure.
time,
No, no,
there'll be
I
new
completely
names,
agree.
new
And
acronyms.
it's it has affected us well. It has helped. But the question
Yeah.
is, it can hurt also, right? So, I mean,
So
any thoughts at all? I mean, if I don't know if you've looked at it closely or.
I
I mean, actually, if you look at the
watched.
S&P chart or the Nvidia chart, I mean, I think it's the same. As you said, it's the same thing now.
Yeah, I know. And it has a lot of domination, but as I said that, when a stock moves in that percentages, you have to give it that big ranges also. Like a
Right.
3%, 5%, 10%, Nvidia is no big deal because the stock also goes up 50, 70% in a few months. So I feel that that is not an issue. You'll have to look at that stock in its own way. But coming to the bigger question that as far as US goes, I feel that there is immense amount of breadth. The way some of the small caps have started doing well, the Russells, etc., also give you a lot of confidence. So I think that there's a lot more depth, a lot more strength in that market, in that economy. One day, I mean, is not doesn't end a bull market. I feel that the bull market has a lot of legs.
Okay, all right, Atul, appreciate you joining in. Thanks a lot for joining in, giving us your view, and we'll keep that in mind. Trend is your friend till it doesn't bend, so we'll hold on to that thought, and looking forward to chatting up with you soon. Well, let's
How do you know
focus
where
on
it bends? How do you know where it bends?
that. You'll join us next time and tell us that, right?
Yeah,
All right.
that's the challenge.
Have a good day, Atul, and see you for a walk later in the evening sometime around in Bandra. Take care.
Thank
Thanks a lot. Well, let's move on then. Fortis Health will acquire 31% stake held by PE players in its diagnostic arm, which is Agilis Diagnostics. To talk more about this development, the way ahead as well, we have Mr. Ashutosh Raghuvanshi, the MD and CEO of Fortis, who joins us on the show. Hi, sir. Good morning. Always good to speak to you. And thanks a lot for joining in here on CNBC TV18. Tell us about this latest development with regard to this PE stake. What does it take your stake to, and what are the plans out here?
Yes, so thanks for having me. So this was something which our PE investors had come in year 2012, and they have been very good partners for the business. We did have an obligation to provide them an exit, and they had a right to have exercised their put option, which they have. And this 31.8% for about 1,778 crores is what we are going to acquire. And that would take our shareholding to approximately about 88% post this acquisition.
Okay, all right. So the amount you're going to be spending is 1,780, right?
778 crores, yeah.
How do you fund this?
So we are an FOFC company, so we have to use an FPI debt route. So we will be, board has approved a listed secured non-convertible debenture for 1,550 crores, which we are applying for all the necessary clearances and shareholder approval. Once that is done, then this would be concluded.
Okay, all right. And what about an IPO then? You know, since post this particular deal, the next trigger the street will be looking forward to is what are the plans with regard to a listing? Back of an envelope calculation suggests that, it's currently valued at around 550 crores, 5,500 crores or thereabouts. Your comment on that?
Yeah, so Anuj, that's not something which we are focusing on right now. There are several reasons for that. And one of them is, that this business has underperformed to some extent, as you're aware. And we have had a lot of headwinds. The brand change had a negative impact as well. And then there was, some impact from the increased competitive intensity as well. So our focus right now would be to create these channels and digital channels, especially increase the presence in the specialized tests, genomics, etc., and improve the performance, bring it at par with the other industry players before we think of any event now.
Got it. So no IPO plans as of now. Mr. Raghuvanshi, this is Nigel on this side. And I have just one more query on this particular deal before we close the loop on this. As you said, the performance has yet to catch up. I think in the first quarter, the growth was low single digit, with margins in those high teens. What's the outlook for the remainder of the year on this particular asset?
Yeah, sorry, Nigel. Yes, that definitely is been the case, but we are seeing the performance improve. The revenue was kind of static for the last quarter, but we are seeing some improvement happening there. And all the efforts which we have started doing on the operational side in terms of increasing our contact points, etc., is yielding results. Certainly, the profitability is improving, and we expect the performance to improve from the previous quarter.
Mr. Raghuvanshi, hi, good morning, sir. Just to give us an update for the second quarter so far for the hospitals business. What's the so far, what is occupancy looking like, and RPOP, etc. Just some sort of numbers there for Q2 so far.
Yeah, so Q2 trend has been good. The occupancy numbers have slightly improved from the previous quarter. We had about 66% occupancy in the previous quarter. Now we are trending around 67 to 68% at the moment. And the RPOP numbers, as I had said earlier, would probably grow in a more modest way going forward. But so far, the growth has been good. And we are seeing that as a result of essentially this is coming on the backing of improving the case mix and also the surgical numbers improving.
Okay, got it. You know, every time you are on, Mr. Raghuvanshi, I always ask you about that IHH bit. And is there any movement at all? What's the latest? He's not kept the stock back, or it's not. I mean, investors have, of course, looking forward to it, but it's not as if it's really hurt them because stock's done well. But any movement? I mean, it was going through the sort of courts and legal process. Can you tell us what's on?
Yes, so the High Court hearings have been happening very regularly. We expect that these hearings are almost towards conclusion. So there are maybe one or two dates which we will probably get, and that is happening within the month of September. So I think some resolution on that side would happen. At the same time, there is a movement on the brand side as well. And if we get the brand at a reasonable price, we would certainly be looking at acquiring the brand as well.
Sorry, could you explain that, Mr. Raghuvanshi? What do you mean by that? Acquiring the brand?
The Fortis brand. So
Right.
the Fortis brand, as you might be aware, was belonged to the erstwhile promoters company, and that is attached
Correct.
towards the proceedings in the Daiichi case. So Daiichi
Right.
has made an application in the court to resolve this brand matter and give them the necessary payments. So we are sort of there in the High Court, and we will try to acquire the brand if there is a reasonable price at which it is available. And this matter is also likely to get resolved quite soon because this is already being heard in the Honorable High Court.
And these are two separate matters, right? The IHH and, of course, the brand matter. And
These are,
ball.
yeah, these are two separate matters.
And what you said reasonable price? I mean, what are we looking at in the ballpark? I mean, if you can give us some indication.
So I mean, this matter is sub judice. I would not really like to comment because Daiichi has submitted some report on what the valuation should be. And so I would not be able to comment on that at the moment.
All right, very quickly, Mr. Raghuvanshi, before we let you go, we understand that you were looking to sell those not very profitable hospitals. I will outline that, the ones I think with margins of less than 10%. And by when do we see this take place?
So we have already exited 2 hospitals in Chennai last year. But there are few other smaller hospitals which we would look at, but those are not the larger ones. They are just the small facilities. We would probably be evaluating that, and maybe one of them we would try to exit within this year.
All right, Mr. Raghuvanshi, thanks a lot for joining in and giving us a fair idea about the recent deal, about how the hospital business is shaping up, and also your plans going ahead. We look forward to having a chat with you in the coming weeks. But for the time being, we'll slip into a short break. On the other side, we'll have Mr. Thiagarajan, the MD of Blue Star, to discuss how demand trends are shaping out. We'll also get excerpts from our conversation with the top management of Bajaj Housing Finance. Stay with us.
Welcome back. So the market's still dealing with that cut of about 170 points. That hasn't changed for now. The Bank Nifty is actually down 400 points. So an eye on this index for sure to see how things progress. But banks and IT both fairly weak, at least at this point in time. Let's now put the spotlight on Blue Star. The first quarter was a fairly good one for the company, with strong revenue growth coming in and the sizzling, scorching summer leading to, of course, robust AC sales. Let's talk about how the company is now gearing up for the festive season and how the second quarter has shaped up. Well, we have with us Mr. Thiagarajan, MD of Blue Star. So great to have you on. So you started off the year on a very, very strong note, and the guidance for the full year is also fairly robust. I think you're looking at 20-25% top line growth. But let's talk about the here and now in the build up to the festive season. I mean, what is the channel inventory like? And are we going to see a lot of competition, more discounting, etc.? What are you forecasting and envisaging as the season kicks off?
Good morning, Shilby. It's a pleasure interacting with you. Yes, the year started off well with a great summer season with over 50% growth. Industry has done well. We have done well. And we look forward to a great festival season. As you may recall, the last year festival season was a great one. The growth was over 20%. That came after a very bad summer season. So one will have to wait and watch if the summer season would have been great this year, how the demand is going to be. But going by the feedback from the channels and the market, I think, again, 15 to 20% growth during the festival season is very much possible. As far as the prices are concerned, we all increase the price due to input raw material cost escalation only in the month of June. As of now, the prices are stable. And I do not think that there is going to be discounting in a big way during the festival season. Having said that, it all depends on how the market is going to behave.
Fair enough. So while you're confident of at least 20% festive season growth, I suppose a lot of that will actually show up in Q3, right? Towards the latter half of September, October onwards, when we get into the season full bloom. Now, for the second quarter, could there be weakness? Because we've had a very extended monsoon. June, actually, the monsoon didn't take off. July, August, and maybe even extending into September. So could that be a bit of a dampener on just, Q2 sales?
A couple of points. The first one is July was a good month. July forms part of Q2, fortunately. And there is already, due to Ganesh Chaturthi and Onam, some kind of pickup is there in the market. So therefore, it may not be a bad quarter as far as the room air conditioners are concerned. Still, there will be growth. I think the growth even in Q2 should be a double-digit growth. And as far as Blue Star is concerned, our portfolio covers even B2B in a big way. The commercial air conditioning, commercial refrigeration, these businesses are not dependent on summer season. We are doing extremely well in commercial space.
All right. Hi, good morning, Mr. Thiagarajan. Good to see you, Ben. Tell us about the industry dynamics, the demand-supply situation. How is it? There was a bit of a mismatch, I understand, earlier in this fiscal. How is that panning out?
Good morning, Nigel. The mismatch was a welcome mismatch because the demand, as you know, in April was over 70%. Again, in May, over 70%. Overall summer, more than 55%. So there was mismatch. But there is absolutely no problem now. The supply demand will be met. The industry is doing well. Localization has taken place in a big way. The only constraint we are all facing is with regard to certain raw material supply chain, which are import dependent, like the compressors or microprocessors or copper. And but that should not impact any demand for the summer, for the festival season. But building up to the next summer season, we all will have to plan, and we are in touch with the government. We are in touch with other stakeholders in order to ensure that we are able to deliver the higher demand that is taking place. The market is growing, and it is the era of room air conditioners. This is a category which has the potential to grow exponentially.
Okay. I wanted to ask you about, there was a headline yesterday that the world's #1 air conditioning company, Daikin, has signed a MOU to sort of set up a new factory on a 33-acre plot in, I'm not sure where, but it's in South India. So, I mean, but we've spoken enough about this in the past, right? I mean, a lot of capacity, a lot of competition, and you've sounded more benign over the last couple of years, saying that, you know, it's not from looking like it was going to be an excess amount of supply, it's going to be evenly matched now. So you'd stick with that, right, sir? Briefly.
First of all, Prashant, it's nice to interact with you. We have also procured land of area 40 acres in Sri City. Sri City is becoming the new air conditioning or consumer durables hub. Who is who of the industry is present there, or at least in Chennai. So earlier it used to be concentrated in northern region. Now Sri City and Chennai has become important destinations for room air conditioners. Now we had commissioned a factory which was 20 acres, and we have another expansion plan for 40 acres. That construction should begin within next 1 year or so, or at least within a couple of years. Now, what I meant last year when I interacted with you in some forum is about PLI scheme. We think PLI is based on production, but the PLI is earned only by incremental sale. Now, if you look at 2023 to today, the manufacturing capacity has grown by 50%. If you take 2022, by now it would have doubled. Whether the market would double is the question. If it is not doubling, what will happen is we all have to show incremental sale in order to earn the PLI. So whether the capacity is getting expanded more than required, yes, I think so. But going by what we experienced in summer season, it is good that it happened. Now, between now and 2030, from the current market size of around 12 million units, it will be more than 28 million units. We are looking at 2030 as a 30 million unit market. And in that context, that fear is no longer there. You are right.
We need all the expansion that there is. Thank you very much, Mr. Tyagarajan. Very well explained and put it in context. Appreciate you joining in, and good luck to you and your team as you execute on some of those expansion plans. Bajaj Housing Finance's much awaited 6,500 crore IPO will open for subscription on the 9th of September. The issue includes an offer for sale for 3,000 crore rupees and a fresh issue of 3,560 crore rupees. My colleague Reema caught up with the chairman Sanjeev Bajaj and managing director Atul Jain on the IPO and, of course, what's on offer. Listen in.
Clearly, the RBI requirement, given our size and being in the upper layer, was to list before September 2025. But what's equally important is that while Bajaj Housing Finance is only a 7-year-old company, as you mentioned, assets as of 31st March 24 at 91,000 crore, the fastest growing housing finance company, the largest non-deposit taking housing finance company. So it becomes important to diversify our sources of borrowing as well. Our capital has all come from the parent, that is Bajaj Finance, the last 7 years. So it's a combination of size and the RBI requirement, both I would say.
So talking about size, now your balance sheet is nearly 1 lakh crore rupees, I think 97,000 as of the June quarter. Do you think the current scale and size is a hindrance for the company to continue growing at 30% that you've seen over the last couple of years?
So let me start by saying that the opportunity for housing in this country, not only because of the way the country has been growing the last decade, but also the additional focus that the government has brought in so that there is housing for all. There is a long way to go. And while we don't target any particular growth number, we've been able to see very strong growth in the last 7 years. And this is on the back of both the opportunity that exists, the capabilities that the management has built, which Atul will talk about a little bit more now, as well as the high-quality performance parameters that we've been able to report quarter on quarter. But I'm sure Atul will detail more.
So do you think 30% is sustainable?
Surima, like Sanjeev called out, we do not target a particular number. Of course, the market size is very large. If you look at a housing market itself, let us say home loan market, which is the largest part of a mortgage market, the market by plus some estimates plus minus was 30 lakh crore plus as of EUM in the country. Loan against property 10 lakh crore plus. So the kind of a market size which is there, compared to that, our size, relative size of a 91,000, 97,000 crore as of a 30 June still remains small. So we have an opportunity to grow, but we are not guided by a particular number. Subject to opportunity, market opportunity, and our ability to take space to the extent what we can take. Happy to get the outcome. More important and relevant part is, the market being very large is one part. This is also growing at various estimates on the industry at a 13 to 14% kind of a CAGR, which is a very high pace of a growth, and the way forward for the industry as well, given housing focus of the government in the country, given low mortgage to GDP ratio of India compared to even other economies.
Has the competitive intensity come down because HDFC Limited, the giant in the space, has merged with HDFC Bank?
At this point of time, the competitive intensity is still high, and it's not only despite HDFC having merged, but if you look at the overall lending opportunity in the country, the one segment where banks would be traditional lenders in the private capex space for corporates has been slow, though we've started seeing some green shoots there the last few quarters. And in the absence of that, banks have participated in lending for homes because that is the largest retail asset class and one of the safest retail asset classes as well. So yes, so the competitive intensity continues to be there. But on the other hand, you know, what's life if there's not competition? That's what creates some fun.
And what about the average ticket size? Because your average ticket size is about 46 lakh, and that's much higher than the peers. And you've opted to operate in that prime segment, which is giving home loans to 50 lakh plus. So is there going to be change in that strategy? And what about affordable housing? Because you've set up a strategic business unit to cater to that.
So Rima, we are not, we don't exclude, like I said, that we are operative in all segments and all sub-segments of the market. But at a point of a time, the focus can be on a particular segment. So the focus in the past had been largely on the prime with the dominant portion of the salaried book, which is reflective of the book composition or the ticket size of the book. But we are present in whether affordable or non-prime. Because there are no standard definitions, that's why I'm choosing to call non-prime whether affordable or a mass affluent. And basis the experience, basis again the risk metrics, what we see, basis the returns, risk-adjusted returns, what we see, the mix will evolve.
So Sanjeev, talking about this current IPO, it's an offer for sale of 3,000 crore rupees plus a primary capital raise of 3,560 crore. So this primary capital, fresh issue, is going to be growth capital. You're one of the fastest growing housing finance companies. So this money that you've raised is going to suffice the company for how long? When do you think next the company will need to come to the market?
Well, with the internal projections on where we are likely to be in the next couple of years, and which today I'm not at liberty to share with you, but once we are a listed company, as I said, that thing could change, that situation will change. But we think for the next couple of years, this should suffice. And as you know, we have the requirement to dilute 25% over the next 3 years. And depending on how growth is going in the coming years, we'll take that call between primary and OFS.
Okay. So when you say couple of years, we're talking about 0 to 3, 3 to 5, more than 5?
Right now, this capital should be for the next 2 to 3 years. But again, as I said, it will all depend on industry growth, our growth, so I'm not trying to project anything right now.
You always think long term, right? So today, promoter stake comes down to 88%, approximately. Eventually, you will bring it down to 75%. What about thereafter? Will Bajaj Housing Finance continue to remain a subsidiary?
Our plan right now, keeping in mind that we have a very long journey before the risk of not being a subsidiary for the foreseeable future, very much so.
And what will Bajaj Finance do with the 3,000 crore that they're raising?
Well, Bajaj Finance is also very much a growing company, so it will continue to use that capital for future growth.
Are you seeing any signs of stress in the market right now? Your asset quality is best in class, pristine, if I may use that word. But are there any signs of stress?
No, not in the housing finance space. In the segments that we are in, a combination of very thoughtful acquisition strategy, leveraging data, leveraging analytics has helped us ensure that what the business that we have built in the last 7 years, and even as we see it right now, is of high quality. So these are also choices, Rima, to be made. And you asked a question on affordable housing finance as well. Now, as we build out each of these business lines, we are also thoughtful to not just do everything together, because then you end up taking disproportionate risk. We are balancing it out by building the teams, building the tech capabilities, the distribution ability, trying to understand what customer segments we need to participate in, and that way gradually build out each of these lines. And as we gain more experience, and I'm sure we'll make some mistakes, we learn from that and apply that back. And that's been our learning from Bajaj Finance over the last 17 years and our learning from housing finance the last 7 years.
Okay, well, that's an interesting chat with the management of Bajaj Housing. That's the big housing finance lender which is making it to the market. That's Ecos India Mobility, the listing ceremony out there at the NSE. And you've got representatives, bankers, promoter, of course, and the family celebrating with the gong going. About 17-18% higher is what you have coming through on this one right now. So it's a strong one. But of course, I mean, we've had stronger. You had the Premier Energies one yesterday, which of course was almost a doubler at the word go. In a subdued market like today, a 20% pop, not bad, and volumes are pretty large as well. We'll have more on this as we go along. Shilpa Rao, the Prabhudas leader, is with us. Shilpa, good morning. Good to have you back. So, you know, we are holding with a 170 point cut, 25,100. What would you do here?
Prashant, yes, like we spoke in the morning, I believe that 25,000 is definitely holding on. From here, 25,300 is again one, target that one should look for. And Bank Nifty, like we've already discussed, 51,500 has to hold again for any sort of upside. So Bank Nifty will be a wait and watch. Nifty can still be a long side trade from here.
Okay, all right, got it. Thank you very much, Shilpa, for that. We'll take a break on that note with the news that individual stocks are actually doing much better. Shilpa, actually, speaking of individual stocks, what about beyond the index? I mean, are you looking at any stock-specific trades today?
Yes, Surbi, I would like to again focus on Hero Motor. Hero Motor in the morning, like we've spoken, it has taken good support at around 5,600. Now the stock is trading at around 5,700. I believe it is still very strongly placed for targets of 5,850 to 6,000 this series. So very strong upside for Hero Motor from here. The other one would be a buy in UBL. I mean, all the entire space, the brewery space is actually buzzing now. UBL is very well placed. Now the futures trading at around 2,050 from here. Keep a stop loss at around 2,025 and look for targets of 2,100 to 2,120. And the same has been recommended in Prabhudas Leela today as well.
Okay, all right, got it. Shilpa, thank you very much for joining in. You have a good trading day going ahead. Before we take a break, we should pull up the mid-cap index because while the Nifty is still kind of struggling with that 160-point gap down, mid-caps are doing better. There's a lot of individual level stock-specific action going on, and that index kind of tells you the story. Pull up NIIT. There's a block trade on NIIT. Remember, NIIT has been in such sharp focus with promoters adding to their shareholding, with Mr. Ramesh Damani checking in. There's another block this morning. I think about 0.7% equity moving around, and the stock's up 10% after that. So lots of stock-specific action. Let's take that break. We'll come back on the other side and put the spotlight on commodities, see how the commodity markets are shaping up. Welcome back. So we've seen the equity market reel under the impact of what happened overnight and the whole Nvidia issue with the US subpoena. Let's find out what's the latest in the world of commodities. We have Manisha Gupta joining in with exactly that. Manisha, earlier we discussed crude. What else are you looking at now?
Well, I'm still talking about crude. Have to put that point across because a very sharp decline is what we are working with. You know, the month of July and August saw the crude oil prices trade in the negative, and the September is started with a very sharp decline onto this one. An overnight decline of 5% is a huge one. The markets were anticipating further decline in crude oil prices, but a 5% cut is something that not many were expecting. So we are now trading at a 9-month lows when it comes to crude. We've broken below 75 for Brent, below 70 for the WTI crude oil prices also, and the charts only have gotten weaker from here. Also, when you look at the Chinese data, all of that has been coming on the weaker side. The manufacturing PMI was weaker, that came in yesterday, and the services PMI number that came in today also has been lower than what the street was anticipating. And then this is a hanging sword really, with OPEC and members will now be increasing production starting from the month of October and gradually increasing it until September 2025. So October will bring in an extra 180,000 barrels per day from OPEC and allies. That would be increase in supplies. Not just that, resolution also seems to be in sight when it comes to Libya, and that was one factor that was supporting prices. But production could be coming back. Exports could begin from Libya starting as early as next week itself. It's something that's weighing onto the markets as well. So when you look at the overall Libya numbers, what the street is looking at is that 959,000 barrels per day is what we saw previous week. This week it declined to 591,000 a barrel. But the kind of high that Libya has been producing, so when you look at the July numbers itself, it has been at 1.28 million barrels per day. So if all of that starts coming into the street from September, that means there is increase in supply from there as well. And it's not just about crude oil prices. If you look at gasoline, well, you have futures declining by 6% overnight. It's a 32-month lows for the gasoline prices also. The U.S. summer driving season is just about ended and the demand hasn't been so great. So if you look at the gasoline inventories, well, those also are high at 218.4 million barrels, which is higher than what we saw in the previous year. So this is another factor. It's not just that. Heating oil prices also have continued to decline. That one is trading at a 15-month lows. We've seen 4.5% of a decline in last month. And the dollar index trading at a 2-month highs, rather 2-week highs, is another thing that continues to weigh onto the market. All eyes right now, of course, at the global markets and then the U.S. non-farm payroll data. That would get you on where the street can move on from here.
Okay, all right, Manisha, thank you very much for that. With that, let's move back to stocks now. We have Yash back with us to talk about GIC-RE, where the government is finally going to be selling some of its equity stake. Yash, what are the details?
Well, Surbhi, it's been a long-awaited offer for sale in this particular counter, that is GIC-RE. The company listed back in 2017, and since then there has been no dilution from the promoter, that is government, as far as the stock is concerned. Government still holds about 85% stake in GIC-RE. 15% is all we have in the public market, out of which 5% again is with LIC. So in absolute terms, very, very limited stock in the market. But now with this OFS, in the larger context, it will be a positive because there'll be more supply into the public market. The government has decided, to launch the OFS today. As far as the total size of the OFS is concerned, 5.95 crore is the base issue. Another 5.95 crore would be a green shoe option, totaling to about 6.98% stake additionally, which the government would be supplying into the market. Now, stock is down about 4.5% today, and that is largely because of the discount which has come in, 6% discount to what the stock closed yesterday. The market was anticipating the discount and the final price, the floor price, to be more than 400. That came at about 395. The stock digesting that particular point. But in larger context, certainly positive, as there would be more supply of paper into the market as far as GIC-RE is concerned.
All right, Yash, thank you very much for that. That's GIC-RE in focus. Now, Godfrey Phillips has finalized the sale of its retail business to a startup called New Shop. Sources have said that the term sheet has been signed to transfer 24/7 stores, and the transaction will be completed this month. My colleague Ashmit is here with details. Ashmit, take it away.
Well, an important development this coming in from Godfrey Phillips, especially ahead of the September 6th AGM. What we've learned, what sources tell us, is that the company has finalized its plan for sale of its retail business 24/7. The format, 24/7 format stores will now be sold by Godfrey Phillips. Those plans have been finalized. Importantly, it's being sold to a startup, the Delhi-based startup. The new store essentially already is in the convenience store business, has about 160 stores across 35 cities. That will be the company taking this forward. Now, what's important is that the term sheet importantly has been signed. The talks have been underway for a very long period. The term sheet importantly has been signed, which signifies, of course, forward movement in terms of when this transaction is to be closed, in terms of timelines. Both the parties are keen on moving aggressively and closing this transaction as soon as possible. The timeline that we hear, that they tell us, is the end of September is when they're looking to close this transaction. And in the spirit of wanting to close this transaction, what we also pick up from sources is that there are efforts already underway by both sides for beginning to transfer the stores and the assets of 24/7 to new stores. So a hugely important development this, especially in light of the promoter dispute which is underway as far as the boardroom is concerned. The reason being that the executive director, Samir Modi, has been steadfast in his opposition to the sale of 24/7, the retail business. Beena Modi, of course, and the other board members, the broader board members, are in agreement with the sale of the retail business. So there is some amount of underplay there, some amount of undercurrent there. We'll, of course, see all of it play out at the AGM on September 6th.
All right. Thank you, Ashmit, very much for that. Well, with that, we head into a quick break. On the other side, it's our segment, It's the Economy. Today, Lata will connect with Mridul Sagar, former RBI ED, to discuss the workings of the current inflation targeting framework.
Welcome to It's the Economy, and this is a very important debate. For the past 8 years, the Reserve Bank's Monetary Policy Committee, MPC, sets interest rates according to an inflation targeting framework which was put in 2015. That is, the MPC has to ensure that CPI inflation remains at 4% plus or minus 2%. That is, CPI has to be between 2 and 6%, preferably at 4%. Now, this framework got its first challenge yesterday when the Chief Economic Advisor, Dr. Anantha Nageswaran, in an article in Mint newspaper argued that Reserve Bank anyway cannot control food prices with interest rates because food prices rise due to, supply side reasons like droughts, crop failures, etc. He therefore asks the Reserve Bank to go back to the previous to the inflation targeting approach. There was a multi-indicator approach where Reserve Bank managed many goals like growth, inflation, financial stability, external stability, etc. Now, it is possible, therefore, that the MPC meetings, as we have known them for the last 8 years, may end and give way to a new or a tweaked framework. So what we are discussing is rather, important. Joining me to discuss the working of the current inflation targeting framework and whether and how it may have to be changed is Mridul Sagar, former executive director at the Reserve Bank and a former Reserve Bank member of the MPC, currently professor at IIM Kozhikode. Mridul, thank you very much indeed for joining us.
Thank you, Lata. Yeah.
Well, first up, this argument must have come up even before the IT framework was set up by the Urjit Patel committee, right? That anyway, RBI cannot control food. So, how would you reply to that? It's a very valid point. If there is a crop failure, onion crop failure, how will your raising interest rates help?
Lata, it's very clear what is intended here. What is intended is that you can't ignore more than 45% of the weight of the prices and expect to control the overall inflation. Now, it's true that monetary policy cannot affect food inflation a great deal except for certain protein-rich items where it matters where the demand is. But what one looks for is generalization through the food inflation shocks, which come very frequently, especially in an economy like India, which are frequent and sort of become large. Therefore, inflation expectations get affected. And so the core sort of like then
automatically
translates. The food inflation part affects the core inflation. The transmission is pretty fast there. And so you need to keep a watch on inflation expectations.
That is also the point which the Chief Economic Advisor is making. Because in the past few months, we have seen core inflation go down from maybe 5% year ago to 4% start of 2024 to 3% now. And in a part of this period, food inflation has gone up, but it has not spilt over into core. So he's even questioning that thesis, whether persistent food inflation always spills over into core. In this case, it hasn't.
We have to wait and watch. Like it's a 7-month-old story that we have an average core inflation of below 4%. And and for that matter, the headline is coming down also.
Yes.
So one can't really argue that it has no effect. So I think it's an overplayed story of core or the headline. For practical purposes, the central bank's communication is on the headline, and that's the metrics which matter for the consumers, consumer price inflation. That's what the monetary policy tells us. But always behind that, the core gets a higher weight in the metrics. So it's not, suppose, for instance, the APPAS models, the forecasting models, the core has a special role. So it's not a debate which is cast this way or that way. The two have to be seen together. Every central bank targets the headline.
Okay.
I mean, last time you mentioned to me that Thailand did core.
Core was what I was
Thailand
saying.
experimented for 3 months and got out of the core.
Okay.
So it's back to the headline. Japan also does the headline. Maybe some fresh items it knocks off. That's all.
Okay.
So
the near universal experience is to attack the headline, or at least
I
target
think
the headline.
invariably rather.
Okay.
Every inflation targeting central bank does headline.
Oh, Okay, okay. Now, suppose you have to recast it. I mean, let us assume there is a debate starting from yesterday and it goes on up until March. The inflation targeting framework has to be rediscussed and endorsed by Parliament every 5 years. Now, if it has to be changed, say you want to include core also as I don't know how it would be tweaked. Will it require parliamentary approval or will the whole thing have to be disbanded?
So, Lata, this is the confusion that is created out of a very, very important academic debate which Chief Economic Advisor has stirred. But let me be very clear where the law exists.
Okay.
The law is very clear. This is an act of the Parliament that we have an inflation targeting framework. The 5-year review is about the numerical targets which the government set. And that invariably has to be the CPI inflation because that's the part of the act.
Okay.
So that's not subject to the review.
The only thing that you can review is whether it is 4% plus or minus 2 or plus or minus 1.5 or whether it is 4 or 5%.
Absolutely.
If you want to add core, you have to rewrite the law.
You have to rewrite the law. You have to go back to the Parliament and then seek its approval. See, it's again this criticism that this is unelected power and stuff to the central bank. It's not unelected power. It's coming from elected power. It's delegation, a very sensible delegation to the monetary authority, which most central banks are now enabling them to do inflation targeting.
No, I'm glad you brought that point because I think point 4 or 3 of the CEA's article in the Mint says that the Reserve Bank itself in its monthly bulletin and elsewhere says that it is the government which is able to control food prices, fiscally manage it, either by releasing stocks or by using tariff policies. So it begs the question, in his own words, it begs the question, therefore, if the fiscal authority is managing a large part of inflation, should they not be part of the decision-making body, which is the MPC? So, are there instances where the MPC comprises government representatives?
Maybe in Russia.
Okay.
So that speaks for itself.
Okay.
Not elsewhere.
Okay. Elsewhere, they are very clearly separated from government.
Central bank independence is core to inflation targeting. Okay. So central bank independence, all this stemmed from Kenneth Rogoff's seminal piece in 1985 in Quarterly Journal of Economics. Yes. And this is scientific. This is not about doctrine. This is not about dogma. There is scientific evidence behind inflation targeting, both theoretical as well as empirical.
No, that point is taken, but the Chief Economic Advisor also says that there have been many instances, even globally, when inflation targeting only by the central bank hasn't worked. For instance, in Japan, the central bank tried everything possible to stoke inflation, bring inflation up. But it is only when the fiscal authority got together and turbocharged, as he calls it, that inflation came back. So only when the two work in sync, the result was achieved.
So there's no harm in synchronizing the policies, but this should come basically because aggregate demand management is done both by fiscal and monetary policy. So one cannot work alone, but the autonomy yields certain benefits for sort of inflation targeting, and you are able to reduce the biases, you are able to reduce the output gaps through the inflation targeting, low output sacrifice, and yet low inflation and growth variability as well. So there are a lot of pluses out of the framework.
Fair enough. Now, the argument ends with the Chief Economic Advisor saying that you have to go, that he would recommend that we go back to the multi-indicator approach. At the moment, you all actually have two indicators. You have inflation target of 4% as your main indicator, and there is an addition that growth should also be sustained. But a multi-indicator approach would mean, how many indicators?
Would mean that you have no framework. Okay. It's eclectic.
Okay.
Everybody is confused what's happening. Today, the monetary policy is conducted by transparency. Gone are the days of Alan Greenspan, who said, if you read my lips correctly, then you haven't really read me.
Okay.
So the argument is transparency. Markets volatilities go down. So there are benefits out of the inflation targeting framework.
So when he says that indeed after 2008, the multiple indicator framework has been the way to go even in other countries, and we should therefore go back. When he says that, you think he's arguing for the committee itself, the system itself to be changed?
So he is raising a more fundamental debate about what is the best framework. It's more an academic question than a very practical question. I mean, it's like, inflation targeting has borne an attack, just like you see on Mars. You see people revolve around, people have hit it. There have been laser attacks on the Mars. That's fine. It will survive. Today, you don't have a better framework. And if you need to anchor inflation expectations, that's the framework to live with.
So your point is that going back to the multi-indicator approach without any such committee and without any such target can result in what? Can result in nothing getting achieved?
I would say yes. It will add to a lot of confusion when you have a market economy. It will create a huge amount of confusion. You won't get another Dr. Reddy to run an eclectic framework like that. Even at that point of time, after a point, it became stressed. And you needed a framework.
No, I take your point. Actually, the big fear I have is that when you give multi-indicators, the Reserve Bank can always be caught napping on some indicator, and it will mean strong arming by the government, which has kind of ebbed away after the inflation targeting framework has come into being. Well, we are just starting the discussion with one of the veterans. In the days to come, we will have full-fledged debates on whether the inflation targeting framework has worked and whether it can be bettered when it comes up for review in the month of March 2025. Thank you very much for being with us in this discussion. After a break, it'll be time for Chartbusters.